Hello, my name is Hussein and I'm Forex Optimum Broker Financial Analyst. I'm back again to bring you all new updates in the financial markets that are going to be really interesting to discuss about today. Another trading week has begun, mixed despite some relief on the US debt market. US 10-year Treasury yield stepped back to 1.68% from the highs at 1.75%. However, stock markets were not catching up with this break as European stocks markets ended Monday mostly in the red zone, while American stock gained led by high-tech Nasdaq 100, which rose by more than 2%. We may suggest that the next round of poker with the Federal Reserve Chairman Jerome Powell, who is going to speak in front of a Congress this week, has begun. This time, Fed Chair will testify in front of politicians who could give Mr. Powell a harsh welcome within the next 2 days. And this time, bond yields are even higher. However, it is unlikely that Powell would change its rhetoric, and it is not only his personal position but the point of view of the US Treasury too. The latter needs to borrow a huge amount of money and need a favorable condition to attract investors. What could the Treasury need to get the money? The yields should be higher and the greenback much stronger. Ideally, this should be accompanied by a plunging stock market to make the US debt a true and only safe haven in a stormy weather. If it is a plan, then Mr. Powell is acting wisely, holding the bluff cards. He is playing not for himself, but paired up with another strong hand with nuts that is waiting for all the players to squeeze all the money into the spot. Only when the gambling is over, Mr. Powell may make an about turn in his position. So where are those 10-year bond yields that could satisfy the treasuries? Certainly above 2%. So we may see another set of cards this week as yields may move closer to 2%, pressuring stock markets and G7 currency. For the broad market S&P 500 index, it may even dive below 3,900 points to a first support level of 3,830 points, and then further down to 3,790 points. When the technical picture would turn into a bearish on the S&P 500, which may plunge to 3,450 points. It is hard to imagine what could cool off such scenario and trigger another rally in stock indices. All market is in a continuous correction of a world economic growth is slowing down from the 10th week in the now diminishing the potential demand for crude. Technical picture suggests further decline in prices of $62.80 to $63.90 per barrel of Brent crude. If the pressure would be severe, prices may slide to $61 per barrel. This level would be interesting for considering a buy position. Gold prices are in a sideways momentum in a range of 1700 to 1750 per troy ounce. If we look at the present yield in the debt market, we may suggest prices should be below $1,700 per troy ounce. But investors may still assess the current situation with treasuries for further developments. Basic scenarios suggest that 10-year treasuries yield would rise above 2%. So we may expect gold prices to decline after a break towards long-term targets of $1,400 to $1,450 per troy ounce. The greenback is a click away from the midterm upside move. The Euro USD is still holding near 1.1940. The pair is looking for a sufficient push to dive to 1.530. The same picture is very much likely for GBP USD, where weekly support level at 1.39150 holds the line for the pound. Power statements may become the trigger to dump the pair to 1.3510. Last but not the least, the USD JPY is steady to begin sliding from current resistance levels at 109.00 to 109.50 to the lower support level at 106.50. However, this is the minor chance for the upside big spike to the 110.50. with the pair may finally rebound towards. Well, guys, thank you very much for listening. Wish you a great week ahead. See you guys later. Bye bye.